Welcome to our math lesson, and this time round we are going to look at simple interest and compound interest. We are first going to begin by looking at the simple interest, and it is important to note that whenever somebody borrows a particular sum of money, or when you give or you lend your money to a particular company or bank, at the end of the year or at the end of every month, it normally accrues what we refer to as some interest. So it's like rent, which you are either earning or gaining from that particular investment. We will begin by looking at a table for us to be able to generate a formula that's normally used to calculate simple interest. Suppose 5,000 US dollars is invested in a bank that pays simple interest at a rate of 5% per annum. So we want to consider this particular case where 5,000 US dollars is invested in a bank over a particular period of time and earning a 5% simple interest. So we'll generate a table . This table will have the interest period, and in this particular case we are going to use years. Then the interest paid in that particular year, and then on the third column we'll have the accumulated total amount. Now in the first interest period, this 5,000 will earn an interest of 5% of the amount invested, which was $5,000. In that particular case, the interest will be 5%, which will be 5 all over 100 multiplied by 5,000 US dollars, which in this case will yield a total of 250 US dollars as the interest on that particular year. When accumulated, on the other column we'll begin with 250 US dollars. On the second year, still because it is simple interest, the 5,000 US dollars is going to accrue an interest rate of 5%. So again, it will be 5% of the 5,000 US dollars, which will still be 250 US dollars. Now, when you accumulate in the first year and the second year, the first year we had 250 US dollars. The second year we had $250. So in total, after the end of the two interest period, we are going to have a total of 500 US dollars. That means you take 250, you add to 250. When you go to the third year, the same thing will happen. The 5,000 US dollars will still accrue a 5% interest. In that particular case, we shall have 5 all over 100 multiplied by 5,000 US dollars, which will still give us 250 US dollars. When you accumulate or you accrue the total, we are going to have it at 250 plus 500 gives us a total of 750 US dollars. The process continues, and you can be able to get the accumulated interest at the end of each year. You can be able to note that the principal remains the same across the 3 years, while the 5% again remains constant or across the 3 years. The only thing that is changing here is time, and that is in years. So if we took 250 and multiplied by 3, we'll still be able to obtain 750 US dollars. So this particular process can be able to yield for us what we call the simple interest formula. Now with the simple interest formula, interest at the end of a given number of years or at the end of a given period of time is normally given by the principal. The amount invested or borrowed is normally referred to as the principal. In this case, we want to refer to it as P, multiplied by rate. And in this particular case, we are going to have rate as a decimal. So multiplied by R. Then we have said for a given number of years, we can be able to calculate the accumulated interest. So we multiply by the time, which will refer to it as N and refers to the number of interest periods. So in short, simple interest is given by PRN, and we have said that R is normally expressed as a decimal. At the end of the period, when you want to collect your money from the bank or you want to pay the loan you took from a bank, you do not pay the exact amount that you took. So like in this particular case, if you had borrowed 5,000 from a bank or invested 5,000 US dollars in a bank, you will not get the 5,000 US dollars. You will get the 5,000 plus some interest that will have accrued at the end of that particular period. For instance, this particular individual, after 3 years, he can claim the 5,000 plus the 750 US dollars which had accrued over the 3 years. So that particular sum of money that is normally picked at the end of the investment period is referred to as the amount, and is normally given by the principal plus interest accrued. So in this particular case, this person will take home 5,000 principal plus an interest of 750 US dollars, which will be a total of 5,750 US dollars. Example. Calculate simple interest and if a total of 1,000 US dollars is invested to a bank paying 5% per annum simple interest over a period of 3 years. So we have been given the principal at 1,000, the rate at 5%, and time as 3 years. We can be able to calculate the simple interest that will accrue to this particular individual over the 3 years. So simple interest, we have said, will be given by the principal multiplied by the rate multiplied by n, and n, we have said, is the number of the interest periods. This will give us, the principal is 1,000 US dollars. We multiplied by the rate. We say that rate is normally given as a decimal, so 5% as a decimal will be 0.05 multiplied by n, which is time, and it is in terms of years. It will be 3 in number. So when you multiply that, you'll get that this person will have a simple interest of 150 US dollars at the end of 3 years. Now, as we said, you can be asked to calculate the total amount that this person might be able to take home after the 3 years. So in this particular case, amount, we'll get it by taking the principal plus the simple interest, and our simple interest in this case is 150. So that will be 1,000 US dollars plus 150. Our amount will be 1,000 principal plus 150 simple interest accrued, which will give us a total of 1,150 US dollars. Another name for the total amount is the final balance. Let's look at an example on that. Alan plan to invest some money for his child. He invests $4,000 for 30 months. In a bank that pays 4.5% per annum simple interest. Calculate simple interest and the amount available at the end of the 30 months. Now here is an individual, Alan, who wants to invest for his child and is putting aside $4,000 over a period of 30 months to a bank which pays 4% interest per annum. Now per annum simply means per year or yearly. That means it consists 12 months. Calculate the simple interest and the amount available at the end of the 30 months. So we are first going to look at the first part of the equation, which is calculation of the simple interest. Now we had said that simple interest is normally given by the principal invested multiplied by the rate, which we said is in a decimal, then multiplied by n. N is normally per year or annually. R, we divide it by 100, and therefore we're going to have the principal being $4,000 multiplied by rate. Rate is 4.5% per annum. That means when we spread it over the 30 months, we are going to have it at either 4.5 all over we are going to have it, the 4.5% as a decimal will be 0.045, but because it is per annum, we can make it to be per month by dividing it by 12 for us to be able to multiply this by 30 months. So in this particular case, the total interest that will accrue on the 4,000 over the 40 or the 30 months will be $450. This is the interest at the end of the 30 months. But the question, another part of the question, wants us to calculate the amount at the end of the 30 months that will be available for the child of Alan. In that particular case, total amount will be given by the principal plus the interest accrued, and our interest accrued over the 30 months will be $4,000 plus $450 which has accrued. So in this particular case, this will give us a total of $4,450. So after 30 months, Alan will have a total of $4,450 in the bank available for the child. We'll also like to look at this hire purchase, or sometimes we refer to it as on terms. Now there are some cases where you might want to acquire property or assets and you do not have the available cash. There are normally terms that are provided by the sellers for them to be able to sell a good number of items. One of these methods is by the use of hire purchase terms, or what we refer to it as on terms. The other means, of course, will be the use of the cash basis, where if you have the cash, you can be able to take it to the seller and you get the commodity, or you acquire the assets and go home. But this hire purchase or on terms basis, the seller will allow you to make a down payment on that particular item, then pay the rest on equal installments, which is normally agreed by the two, that is the buyer and the seller, either to be monthly or fortnightly or weekly. We're going to consider a case of Lucy. So for this particular question, we want to, or we are told that there's a fridge here which has been advertised at a cost of $1,300. Note that this $1,300 is the cash price of that particular fridge. But you've been told that Lucy does not have that money at that particular moment, and therefore signs an on-terms agreement with the seller, which allows her to pay a deposit or a down payment of $300. Then the balance will be paid at $60 per month for a period of 2 years. So the question is, how much does Lucy pays for the fridge? Understand here that the question wants us to calculate the on terms, or the hire purchase price of that particular fridge. We have said that the hire purchase price of the fridge will be given by the deposit plus the total installments that will be made by Lucy. Now we have been told that Lucy on the agreement will be given or will be allowed to pay a deposit of $300, and on the total installments he'll pay $60 per month for a period of 2 years. 2 years has 24 months. Therefore, on total installments, she's going to pay 60 multiplied by 24. This will give us the cost of the fridge over the hire purchase terms at $1,740. Now, if we compare the hire purchase price, which is $1,740, and the cash price, which is 1,300 shillings, you'll discover that when you use this particular method that is on terms basis, you are going to pay much higher. And you pay much higher because you only paid $300 and you acquired a commodity that was costing $1,300. That means there's some particular amount of money that you had borrowed. And in this particular instance, we can be able to say that after paying the deposit of $300, Lucy had borrowed a total of $1,300 minus 300, which will be equivalent to $1,000. So the amount above the cash price, what we call the carrying charge, is what will be referred to as the interest that will have accrued on that $1,000 borrowed or taken away by Lucy. Question B: how much will she had saved by buying on cash? The cash price of the fridge, which was the advertised price, was $1,300. But by paying $1,740 on hire purchase terms, there's an excess amount in which Lucy could have saved. We can be able to get that amount of money that Lucy could have saved by taking $1,740 subtract the $1,300, which will give us a total of $440. So this is the amount of money that was like on excess of the cash price and that Lucy could have saved for some other items. There are some cases where you sign an agreement with the seller and you do not work up to it. Like for example, in this case, if Lucy had signed this agreement with the seller, then discovers that after some particular months, let's say 5 months, she's not able to pay the $60 as it had been agreed. What will happen, for instance? In that particular agreement, although it normally varies with different sellers, it is acceptable for the seller to withdraw the fridge from Lucy and sell it at whatever amount. Understand that withdrawing the fridge from Lucy and selling it at a throwaway price does not remove the financial liability of Lucy. She still has to pay and ensure that she has completed the debt of $1,740. Another example: Wally invests $15,000 at a rate of 6% per annum for 3 years. Calculate the simple interest and the amount available at the end of 3 years. Now again, because we are talking of simple interest, the interest here that will accrue on the $15,000 again will be given by principal multiplied by the rate multiplied by n, which is the period. This will be $15,000 multiplied by the rate as a decimal. 6% as a decimal will be 0.06 multiplied by the time, it is 3 years, so we multiplied by 3. This will give us a total of $2,700. So this is the interest that will accrue for 3 years. The other part of the equation wants us to calculate the amount that is available at the end of the 3 years. We said amount is normally given by the principal added to the interest obtained, and in this case our principal was $15,000. When added to $2,700, we'll have a total of $17,700. Interest is what we refer to as the compound interest. We noted that when you're looking at the simple interest, the principal does not change. It remains constant over that particular given period of time. But now with this particular compound interest, every interest period has a new principal. The principal of the second year, for instance, is the principal of the first year added with the interest that was earned during the first year or the first period. Example: find the total value of an investment if $8,000 is invested at 5% compounded annually for 2 years. So in this particular case, we have said that the 5% is being compounded. So the interest is compounded. That means that we are going to have a new principal each year. The principal for the first year will remain at $8,000, but when you go to the second year, the principal of the second year will change, and we'll have it as the principal of the first year plus the interest of that first that was earned on that particular first year. So interest on first year will be $8,000 multiplied by the rate, which is 5%. So as a decimal, that will be 0.05 multiplied by 1, which is that financial period. That will give us a total total of $400. Now when you go to the second year, we have said that the principal will change. So we'll have the principal of the first year plus the interest that was earned in the first year. So our principal will be 8,000 added to the 400 that was earned during the first year, giving us a total of $8,400. Therefore, the interest in the second year will be $8,400 multiplied by the rate, still at 5%, as a decimal will be 0.05. Then we still multiply it by 1 because we are dealing with one financial period. That will give us $420. So we discover that the first year the interest was $400. In the second year the interest is $420. So it keeps on changing every year and it keeps on increasing at a faster rate. It's not constant like it was the case with a simple interest. So the question was, find the total value of an investment if 8,000 is invested at 5% compounded annually for 2 years. Amount after 2 years will be given by the principal plus total interest. The total interest is now the interest in the first year plus the interest in the second year. So that will be $8,000 plus, when you add 400 and 420, you get a total of 820. So this will be $8,820. Now with the compound interest, because this the principal is normally different at the end of every financial year, then that means if you're supposed to calculate the total amount after 3 years or after 4 years, you'll be required to do what we call a step-by-step breakdown. But because sometimes you can be asked to calculate the total amount that will accrue after maybe a longer period of, let's say, 15 years, you may not need to go step by step. What you need what we call a compound interest formula, which can be generated and simplified to amount is equal to the principal into 1 plus the rate all over 100, or as a decimal multiplied all these raised to n. So this acronyms M stands in for the total amount after n financial periods or interest periods. P stands in for the principal or initial amount either invested or borrowed. Or the initial amount that was either borrowed or invested. R stands in for the interest rate, and N refers to the number of the interest periods. Now with this particular formula, we can be able to find anything that we want, so long as we'll be given these particular items in that particular formula. Let's look at an example in which you're going to apply the formula and come up with the required answers. $2,000 is invested at 10% compounded annually for a period of 7 years. Find the total amount at the end of the 7th year using the compound interest formula. Now we had said that amount after a given period of n years will be given by P into 1 plus R all over 100 raised to n. So in this particular case, the amount after the 7th year will be equivalent to the principal, which is 2,000 multiplied by 1 plus the rate as a decimal, 10% as a decimal will be 0.1. We raise all these to 7 because that is the total number of interest periods that we are having. So this one is going to give us 2,000 multiplied by, when you add 1 plus 0.1, you get 1.1 raised to 7. So when you calculate that, 1.1 raised to 7 multiplied by 2,000, you get a total of 3,897.4342. Now we had said that with money we normally truncate to 2 decimal places, therefore we're going to count 2 after the decimal place, that is 1, 2, and truncate from there. So the amount available can be approximated to 3,897.43 at the end of the 7th year. Another example on compound interest formula. Caleb invested $10,000 with Mental Bank. The bank pays interest at a rate of 7% per annum, compounded annually. The question is, what is the value of Caleb's investment at the end of 5 years? For us to be able to calculate the amount available for Caleb at the end of the 5 years, we have said we're going to use the compound interest formula that says that amount is given by principal multiplied by 1 plus the rate as a decimal raised to n, where n refers to the number of interest period. Therefore, in this case, the amount that will be available at the end of the 5 years will be equivalent to 10,000, which was the principal invested by Caleb, multiplied by 1 plus the interest rate as a decimal, because that was 7%. 7% as a decimal will be 0.07. We raise that to n, and our n is 5. So this will give us 10,000. When you add 1 plus 0.07, you get 1.07, all this being raised to 5. So when you calculate that, you'll get that at the end of the 5 years, Caleb will have a total of 14,025.517. Again, when you truncate that, it will give us $14,025.51. You simply do what you call truncation. Part B of the question: how much interest was earned over this time? So for us to be able to calculate the interest that was earned, you see invested $10,000. At the end of the 5 years, he has $14,025.51. That means the amount above the $10,000 invested is what we refer to as the interest. Therefore, interest will be given by 14,025.51, subtract the amount invested, which is $10,000. This will give us $4,025.51. We also have another concept called depreciation, which also normally goes in line with the compound interest. Now, depreciation simply refers to the decrease of value or in value of an asset over time. Whenever you purchase an electronic gadget or any assets, it might go up in value over a given period of time, or sometimes it might reduce in value. That process of decreasing or reducing in value is what we refer to as depreciation. The compound interest formula said that amount is given by the principal into 1 plus the rate as a decimal, all this raised to n. We can be able to alter this part alone, and we obtain a formula for depreciation. That is, because that particular item or the asset will be decreasing in value over time, we change this positive sign to be negative, and therefore depreciation can be given as P into 1 minus R all over 100 raised to n. Naomi bought a computer 5 years ago at $5,680. She assumed the value of the computer would depreciate at a rate of 25% per annum. What is the value of the computer at the end of 3 years? Now, we have said that depreciation formula will be A is equals to P into 1 minus the rate as a decimal raised to n. A denotes what we call the final value of that particular item. P in this case will denote the current or the original value of that particular asset. So in this case, at the end of 3 years, the cost of the computer will be 5,680 multiplied by 1, subtract, it is depreciating at a rate of 25% as a decimal, that is 0.25 raised to power 3, which is the period of time. So this will give us a total of 2,396.25 to be its estimated cost at the end of 3 years. So you find that in depreciation, the value of an asset keeps on coming down or decreasing in value. This depreciation discussion brings us to the end of the first topic. Thank you.